A balance sheet is a financial snapshot, a single moment in time. It measures wealth and how it's composed. Income and expenses measure how wealth changes, and it's always measured over a period of time. Incomes are items that would increase wealth, and expenses are items that would lower it. Returning to our balance sheet example, I've made a income and expense section. Now, this isn't part of the balance sheet itself. Remember that income and expenses measure how the balance sheet changes from one balance sheet to the next over an interval of time, in this case, a month. So let's put some stuff in here. Let's say you make $4,000 a month. Before tax, you necessarily will pay some tax, so your employer is probably automatically withholding like $600 of tax or so. We have rent, groceries, insurance, just some basic essentials here to keep this simple. And let's say we're not particularly socially active, or we at least are responsible financially when we do social stuff. And then we have no credit card debt, so we have no credit card interest. So if you look at what is happening net monthly, you earn $4,000, and then you have to spend the vast majority of it, $3,800 here, go out in expenses. So your net monthly surplus is $200. This is measuring your wealth or your equity increasing by $200 per month. Your balance sheet should be improving by $200 per month if there's nothing else. So 1 month go by, say, and then your cash will increase from $200 to $400. You might wait 2 months and save up to buy an espresso machine, and this costs you $400, but it is increasing your balance sheet strength because it increases your assets. You might be able to pay down a debt, which would lower a liability. I mean, in this case, you don't have much to pay down. I guess we can lower this by $200, also increasing wealth. Now I want to show you what happens if you took on a high interest liability, because not only do liabilities hurt your wealth, because they lower your equity, right? Equity is assets minus liabilities. But they can also generate additional expenses that hurts how your balance sheet changes from month to month. So suppose we had a $10,000 credit card debt at 30%. This would be very normal in this current interest rate environment. This means you're paying $250 in interest. And this is not paying down debt. This is not paying down your liability. This is how much just goes up in flames each month. Choof, gone in an expense, in an interest expense. So in this case, it has changed your net monthly benefit from $200 to actually losing $50 a month. So with the addition of this debt, your wealth is actually expected to be decreasing now by $50 a month instead of increasing. So lesson here, try to keep liabilities that have high rates of interest off your balance sheet completely, or as low as you can. Avoid those high interest loans. Credit card debt is just so dangerous.